The world of Forex trading is a captivating one, filled with potential for those who dare to navigate its intricacies. Currencies ebb and flow, influenced by a myriad of factors, creating opportunities for traders to capitalize on these movements. One such currency pair that consistently attracts attention is USD JPY, the pairing of the mighty US dollar against the Japanese yen. This pair is known for its volatility and clear trends, making it a favorite among seasoned traders and newcomers alike. Understanding the dynamics of USD JPY requires a keen eye for detail and a grasp of key technical levels. One such level that holds immense significance is the pivot point. In its simplest form, a pivot point acts as a gravitational center for price action. It is calculated using the previous day's high, low, and closing prices, providing valuable insight into potential support and resistance zones. Traders watch these pivot points closely, as they often dictate the short-term direction of the market. Imagine a tightrope walker using a long pole for balance. The pivot point is like that pole, providing a central reference point for the USD-JPY pair. Just as the tightrope walker adjusts their position based on the pole's balance, traders make informed decisions based on the price action around the pivot level. For the week of March 19th to 23rd, the USD-JPY pair finds itself revolving around a crucial pivot point at 149.10. This level acts as a dividing line separating bullish momentum from potential bearish reversals. A decisive break above or below this level could signal the next leg of the USD-JPY journey. Traders will be closely monitoring price action around 149.10, looking for clues to confirm their trading biases. A strong upward surge above this level, accompanied by increased buying volume, would be a bullish signal, suggesting further upside potential for the pair. Conversely, a failure to breach 149.10, followed by a decisive break below, could open the door for a bearish reversal, potentially sending the pair lower. Think of 149.10 as a crucial battleground in the USD-JPY war. Bulls and bears are vying for control, and the outcome of this struggle at the pivot point will determine the short-term direction of the pair. Traders will be watching intently to see who emerges victorious. Given the current market conditions and technical analysis, the preferred trading strategy for USD-JPY this week is to favor short positions. This bearish bias stems from the pair's inability to convincingly break above the 149.10 pivot level, suggesting potential weakness and a higher probability of a downward move. Shorting USD-JPY essentially means selling the pair with the expectation of buying it back at a lower price. This strategy aligns with the anticipated bearish scenario and allows traders to profit from a potential decline in the pair's value. Entering short positions below 149.10 with an initial target of 148.50, followed by 148.00, presents a compelling risk-reward opportunity for traders. Imagine a surfer waiting for the perfect wave. Shorting USD-JPY below 149.10 is like catching that wave at its peak, riding the downward momentum for maximum profit. As the wave loses its energy, the surfer gracefully exits, securing their gains. While the preferred scenario leans towards shorting USD-JPY, it's crucial to acknowledge the possibility of a bullish reversal. Should the pair gather enough strength to break above the 149.10 pivot level convincingly, it could signal a shift in sentiment, opening the door for long positions. In this alternative scenario, traders would look to buy USD-JPY above 149.10, targeting 149.50 as an initial objective, followed by 150.00. This bullish scenario, although less likely, cannot be disregarded. Traders should remain vigilant and be prepared to adapt their strategies should market conditions change. Think of a sailboat adjusting its sails to catch a sudden change in wind direction. Similarly, traders must be ready to shift gears and capitalize on a potential bullish reversal above 149.10. Flexibility and adaptability are key to success in the ever-changing world of Forex trading.